My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Good, my friends, I'm just trying to help you save a little money. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. It used to be a big deal to reach the $100 billion club. Most companies will never, ever see that market capitalization mark. It requires a tremendous amount of hard work and drive to get there. But given how buoyant the market's been lately, despite days like today where the Dow dipped 241 points, S&P declined 0.61%, and the Nasdaq lost 0.62%, the $100 billion level means a lot less than it used to. As of last Friday's close, we had 18 companies that joined the club this year. 18 companies that are now worth more than $100 billion. And they perfectly captured the zeitgeist of the moment. So let's parse through them to figure out what the heck's going on. It could tell us a lot. First, we know there's an umbrella that's changed things here. It's the umbrella of NVIDIA. Here's the stock that's up 180% year to date. I know it doesn't act well right now, please, okay? It was at $48 at this time last year, to $138 change today. When you have that $1 trillion cover, you can't sneer at companies that put on a lot of points in 2024. NVIDIA allows people to justify paying almost double what they paid last year, or in some instances, a lot more than double. Plus, stocks, like everything else, faced a bout of inflation, I think we'll call it. It's still a problem. Well, I don't know. It's there, though. So let's go through the biggest gainers that have joined the $100 billion club with all numbers as of Friday's close. The biggest move, and I know you're going to think this is inflationary, is the staggering 907% windfall that comes from AppLovin, which makes software that helps app developers grow their reach and monetize their apps. It's gone from $13 billion at the end of last year to $121 billion. Although it was a lot higher on Friday, $142 billion. Today, the stock got clobbered, down 15%, because it wasn't added to the S&P 500, something that many traders were expecting, anticipating, gambling on. AppLovin is adapting its stripes and leaning in and pivoting and using its learnings there, worked in all the key buzzwords to become an early-stage e-commerce play that could be wildly successful. They're so good with their mobile gaming technology that they've decided to go all in with video game advertising. These are free mobile games that make their money by showing you ads. Is that worth an almost tenfold gain? The short answer is no. You don't rally that much in a simple line extension. But what if the same technology could be used for all of e-commerce? Now, that's a much more exciting story, and it's one being told right now. I can't fault anyone for suspending the rigor and believing there may be something very big here. Who cares if it might be pure magical thinking? Certainly not the investors. Just look at how the stock roared last week when lots of speculators swooped in, betting that AppLovin would be added to the S&P 500 after the close Friday. Now, by the way, that's another thing that tends to happen to stocks worth north of $100 billion. It didn't happen, and now they're getting clobbered. Next up is enterprise software company Palantir, which exploded on the scene this year with some big contracts and some big growth. Palantir came public via a direct listing in 2020. It kind of hung out doing nothing until its sales finally took off. And then, man, this thing was just a rocket ship. Palantir is the brains behind much of the military that we don't know about. They've been rallying against the big five military defense contractors. They don't like that gang. They think it frustrates everybody else. The firm uses advanced data analysis and artificial intelligence to help the Pentagon see patterns, process data, lightning speed. Again, though, I think Palantir is loved because it's trying to upend the Defense Department, potentially saving tens of billions of dollars and saving the lives of those who might be on the front line, such as precious pilots in very expensive jets. Buyers think that Palantir will reinvent our entire defense budget, which is entirely possible because these guys are tight with President-elect Trump. Third, no one talks about the meteoric rise of Spotify, the audio subscription company with popular figures like Taylor Swift, The Weeknd, Bad Bunny, Chappell Roan, and Billie Eilish, as well as a host of famous podcasters, including the influential Joe Rogan. Spotify rallied 165% year to date, joining the $100 billion club as of Friday's close. Why did it suddenly take off? Simple. The market loves subscription models because they're sticky. Netflix, Amazon, Costco, all subscription businesses. They're raving successes, and now Spotify is too. Next was Apollo Global, the private equity firm that had rallied 93% for the year, joined the $100 billion club as of Friday's close, just like fellow corporate raider, no, we don't really want to call them that, but KKR, up 91%. That's outstanding performance from two firms that truly know how to make money. It's odd to think that they could have such good years without ringing the register by taking their portfolio companies public. Maybe holding on to positions isn't such a bad move. That these two private equity firms are part of a trend that allows startups to stay private longer internally because the process of coming public is brutal with a lot of pressure from regulators and then from money managers. Well, I mean, this is a great way to go. Formerly, these companies had to tap the public market for capital. Now they tap outfits like KKR and Apollo. We are having a tough time getting IPOs to market, which means the ones we do get to tend to be priced too low, thanks to a paucity of buyers. And that's what I think happened with the stock of ARM Holdings, the semiconductor architecture company that's partnered with NVIDIA for all sorts of gizmos, and it's all over the cell phone and servers, too. ARM's growing incredibly fast, and CEO Rene Haas has steered the company's stock to an 87% return, joining the $100 billion pantheon. There's Arista Networks, which provides hardware and software that monitors data and provides solutions for the big data center companies. No wonder its stock rallied 83%, yet it remains relatively unknown, in part because it's invisible. It makes so-called white boxes. So what? The money's not invisible. You can call it this one. Next, we have Progressive. Now it's up 60%. This auto insurer is known to use more AI in pricing than any other company. It's joined by Chubb Limited, the property casualty insurance kingpin, which was up 26%, not to mention insurance broker Marsh McLennan. That's up 20%. The insurance business is on fire, and we know from these egregious CPI numbers that one comes out this Wednesday, they just keep raising rates. These three are winners for certain. Now, there's a big cluster with gains in the mid-50s. First up is Fiserv, the transaction processing company. You know there had to be one fintech here, right? Then there's Eden, Charitable Trust Holding, makes electrical components for the data center. Then there's automatic data processing. By the way, that's a company synonymous with growing payrolls. Isn't that an oddity when the Fed's cutting rates? Finally, there's Boston Scientific, which makes minimally invasive medical devices. We've had them on, mostly for the heart. Some would say it just builds a better mousetrap. Crude and somewhat denigrating, but true. A superior company. You want an anomaly? Hey, how about Citigroup with a total return of 45%, enough to finally let us sneak into the $100 billion club? Not bad. It's part of a failings of banks that are finally getting their due. Last but not least, we've got a cybersecurity company that CNBC Investing Club members know all too well, called Palo Alto Networks, up 37%. Micron Semiconductors does high bandwidth, 18%. Analog devices, that's Internet of Things, up 11%. Big deal for Palo Alto, a huge journey undertaken by CEO Nikesh Arora. But both Micron and ADI are well off their highs, so the whole thing might be a bit of a come down for them. I know we're experiencing a heightened market with expectations really running so hot that you can't believe that a presidential rally, or let's say an end-of-the-year rally, and a stock shortage rally are all in play at once. Many of these stocks got clocked today as part of a sell-off that seemed to infect the year's best performers. I don't know how long it'll last. Maybe some great buying opportunities already. But the bottom line, when you get this much money coming in, you can see how all these companies can reach $100 billion, creating a huge amount of wealth, at least on paper. One more reason why it wouldn't be so bad if some of the winning investors in this market took something delicious off the table. Let's go to Dave in Illinois. Dave.
And Dr. Cramer, my mad short-term S&P oscillator watching friend, how are you?
Dave, I am fine. I'm glad you called. Let me help. What's going on?
Jim, this $55 billion NASDAQ 100 listed company operates an observability, easy for me to say, and security platform for cloud applications. It enjoys a high institutional ownership and has already achieved a 52-week high last month. Of course, I'm talking about Datadog. Up some,
you know, something, Dave. Datadog is such a winner. I think there's a lot of companies that wish they had bought Datadog when it was still private. It's up substantially from then. And I'm going to throw in MongoDB, which reported tonight, and it also has a lot of the juice you're looking for. Dave, once again, always explains things to us. Maybe it has something to do with Illinois. Okay, let's go to Craig in California. Craig.
Booyah, Ski Daddy, the Chillmaster J.
All right, what's happening, my friend? What do we got going?
I've had my eye on the stock here for a bit here. Beverage behemoth there. It seems to be pulled back about 13% in 3 months, trading below its 10-year average PE. Has a very juicy, tempting 3% dividend. I'm wondering, is a good time to take a position in Coca-Cola long term right here?
I think it is. As soon as it got to 3%, I was going to come out and say, you know what, that may be it. That may be the level you can buy. Let's say you want to buy 100 shares. Buy 25 here, buy 25 at 60, 20, and then maybe by 25.58, it probably won't get there, and then 25 around 55, you get a great average. That's the way you want. You want to bet that a stock will come down to your levels. That makes you feel more positive as it gets hit, while you build a better possession with a very good dividend. All right, we got a bunch of different rallies now, types going on right now. I wouldn't blame anyone, though, if they wanted to take a little off the table because, boy, we got some heightened expectations. On Made Money tonight, can airline stocks cruise even higher? I'm seeing if they could gain attitude for the long term, though. Then, I'm taking a look at some signs of complacency in this market. Don't miss the clues I'm uncovering from the VIX and from the junk bond spread. And later, are pet stocks still treats in this tape? I'm breaking down the post-earnings performance from two of the sector's top players. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.